All right, if you're watching this video, you've probably already gone through the all-in-one simulator with me for your numbers to see what those are, and maybe you've even already moved forward with the application for your all-in-one. But like a lot of people, you have the question that always comes up, what is my mortgage payment going to be? And that's a common question. And so I want to clarify that and answer that for you today. The biggest struggle that people have, I think, is that there's no point of reference that we have for this. This doesn't work like a traditional mortgage. It works more like a commercial mortgage where you have a sweep account. So for example, if you're a manufacturer and you have a commercial line of credit for $1 million, well, what happens is you're using that line of credit to pay your employees, to purchase materials, run your business. And then let's say you have a big sale that comes in for $350,000 in revenue. Well, that revenue goes into your checking account, but you still have this $1 million line outstanding, this loan. And so what the bank does is that night that comes in, they sweep it over every night. They apply that $350,000 balance towards reducing your principal from $1 million to only $650. So now you're only paying interest on $650, but it's as if that $350,000 is still available in your checking account. And that's what the all-in-one can do for you in your mortgage. When you think about it, you probably make more money in 5 years than the entire cost of your mortgage, probably even more than the cost of your entire home. And so that money is being utilized by the bank every single night instead of being utilized by you. So we're going to show you how to change that. Here's the key thing that I want you to understand. Your traditional mortgage has a predetermined payment. You're going to pay mostly interest for the first 20 years or more, and your principal reduction is going to be next to nothing for the first 10 years. On the all-in-one, your mortgage payment is not predetermined. Instead, your interest due every month is going to be based on the amount of principal outstanding. Many people think of it this way. On a traditional loan, your income goes towards paying interest first versus the all-in-one, your income goes towards paying principal first. So let me show you an example here. I'm going to share my screen. So real quick, the way that you would traditionally look at this is, let's say you had a $100,000 mortgage. We're just going to use some simple numbers here. So you have a $100,000 mortgage loan. And let's say at today's rates, which are currently above 8% as the time of this recording, and let's say you take a 30-year fixed, your payment on that is going to be $734 a month. Now, if you wanted to pay it off in half the time, let's say you take a 15-year fixed, and actually right now the rates are about the same because the yield curve is inverted. And I'm going to do a link to another video at the end of this that will talk to you about that and how it'll benefit you on this loan. But on that 15-year fix, just to stick with what we're talking about here, you'd pay $955 a month in order to pay it off in 15 years. That's an increase in your monthly payment of 30.1%. Now, if you wanted to pay it off in a third of the time, let's say you wanted to pay it off in 10 years, you'd have to take your payment up to $1,214. That's going to be an increase of 65.4%. So there's some problems with paying additional or taking a shorter term loan. One, you're locked into that higher payment. If something goes wrong with your cash flow, you're locked into that higher payment. You need to make that every month. If you go for 90 days without making your payment, the bank starts knocking on your door and talking about foreclosure. The second problem is you can throw additional funds towards your mortgage. You can say, well, I'm going to take that 30-year fix, but I'm going to try and throw extra money towards it every month. The problem is that you can't get that money back out if you ever need it. So those are the inherent problems with a traditional mortgage. What makes the all-in-one product so unique is that you get to pay off your mortgage in less than half the time without changing your monthly payment habits. So let me show you how and why that works. Okay, so here's what we're all used to. We typically have a bank, and in that bank, we have a checking account, and we have a savings account. And for our example, let's say that you have $4,500 coming in every month as income, and you have $4,200 going out every month as expenses. And part of that expense is that $734 a month in your mortgage payment. So at the end of the month, you're net positive $300. Again, this loan doesn't work for everybody, but it works for those of you that have positive cash flow and have some savings. So let's say that you're good about having at least an emergency fund of 3 to 6 times your monthly income. So 3 times that $4,500 let's say you have $13,500 in savings. So that's your net. Now, what you typically do is you're going to take a mortgage to buy your home because you need that extra $100,000 in this example to buy that. As we said, on the 30-year fixed for $100,000, you're going to pay $734 every month. And of that $734, $67 is going to reduce your principal. The rest of it is going to interest. So at the end of the first month, your principal balance is down to $99,933. And the next month, you're going to pay $734 again, and it's going to reduce it by another $67. And the next month, you're going to pay another $734 again, and it's going to reduce it by about $68. And so about every other month, your principal reduction is going to increase by about $1, and your interest is going to get reduced by about $1 every other month. So you're going to do this for 30 years, which is 360 months. And over that 30 years, if you were to keep that, you'd end up paying back $264,240 on that $100,000 that you borrowed. So now let's talk about the all-in-one loan and how this is going to benefit you. So on the all-in-one loan, you're borrowing that same $100,000, but instead of the money sitting over here earning money for the bank, we're going to put that money into your account. It's going to sweep over just the way it does on a commercial loan. And so we're going to automatically reduce your principal balance by $13,500. Now you still have access to that savings. You haven't paid down the mortgage. You haven't paid it off, but we've reduced your principal balance that you're paying interest on by that $13,500. Now you have that monthly income come in of $4,500. So that's going to reduce it by that amount. And really the way you might want to think about this is that your income is actually your payment for your mortgage. Now, everybody kind of freaks out by that and goes, wait a second, I don't want to pay my entire paycheck to my mortgage. You're not paying your entire paycheck to your mortgage. All we're doing is sweeping that over until you need those funds for the rest of your bills every month to reduce your interest. Okay, so now we said that $4,200 is your monthly expenses less the $734. So that's going to leave you $3,466 and all your other monthly expenses. So as those get paid out, that amount gets added back to your principal balance. So now your principal balance goes up to $85,466. But the interest that you're going to pay on the amount of money that's outstanding is based on that lower balance. And so the interest for your month that's going to come out on the 21st of the following month is $647 in this example using current rates. So that gets added back on. You don't make a payment. It just gets added on to your principal balance. You've already made your payment, quote unquote, when you paid this $4,500 in your deposit. So now your balance is back up to $86,113. All your cash flow is the same. Your income came in, your expenses went out. Instead of making that $734, it's $647, and we're reducing principal. Now we take this up. Let's go and we'll look at this for 2 more months. So let's say what happens in month 2. So we take that $86,113. Again, we have $4,500 coming in. So that's going to reduce your principal balance now to $81,613. You're going to pay your monthly expenses, the $3,466. That's going to take your balance back up to $85,079. And now your interest, because we had a lower principal balance, your interest that's going to get tacked onto your balance is $643 in month 2. So now your principal balance has been reduced to $85,722 in month 3. And again, we're just going to look at this one last month here. to follow this through so you can kind of see how this starts compounding for you in your favor. That 4,500 income is going to take you down to 81,222. Your expenses get added back onto the balance as you pay those out, 3466. That's going to take you down to 84,688. And your interest for the month, when we calculate that, is now down to only 640. So your principal balance has now been reduced to 85,328. So if we come back and look at this, at what's going on your traditional mortgage, you're reducing it by 67, 67, 68. So that means you're going to reduce it by $202 over the first 3 months. Whereas on the all-in-one, we're leaving out that 13.5 because that's money that's your reserve account. And again, you have access to all that money here. So let's use the 86,500 as sort of our starting principal balance. And we ended up after 3 months at 85,328. That's a reduction of 1,172. Now, some of you might be saying, well, wait a second, I've got a net $300 that I'm saving over here. And that's true. So we can add that 900 back on. So you have those funds available. So in theory, you've reduced it by 1,102 versus 1,172. So the all-in-one, just in the first 3 months, is $70 a month better. But that starts to accelerate because, again, we talked about this starting out at 647, 643, 640. And as interest rates start to drop, and again, with the yield curve being where it's at, I'm going to put a link at the end of this video, as rates start to drop, that's going to accelerate even faster for you. But know that this is going to go up, and this is going to allow you to pay this off in under 12 years, just if rates stay the same and never come back down. So here's where it gets exciting. Without changing your monthly spending habits, you can pay off your mortgage in 11.8 years versus 30 years, and that's if rates stay the same. So just so you see what we're comparing in here, we had a $100,000 loan balance, 8% interest rate. There's your $734 a month in payment. We've got your $4,500 in income coming in. We got your $13,500, that one-time deposit that we're going to move that over to offset the balance. And then you've got your monthly expenses of an additional $34.66 going out. So you have your $733, your $34.66. So that's $4,200 a month going out, $4,500 coming in. That means you have $300 left over. Are you with me so far? That calculates out to paying off in 141 months. And the interest rate assumption that we're using is today's current rate is 9.46. So you're using 8% on the comparison product of a 30-year fix. So we're 1.5% higher currently. And even at 1.5% higher, if we start at that rate, which we're at the height of the rate cycle, and for the next 12 years, we stay at that high rate, rates never come back down again, which isn't going to happen. But let's say it did. Even in that case, you're paying this off in 141 months. So now let's look a step further. Let's look at the pay down table on this. So after 141 months, down to it here, you've got a zero balance on the all-in-one loan. You've paid back $100,000 versus you have an $84,000 balance on your traditional 30-year fixed mortgage at that lower rate, and you've only reduced your principal by $15,619. Okay, so just so we're comparing apples to apples here, we said on the traditional mortgage, you've reduced your principal by $15,619. On the all-in-one, we've paid off the entire $100,000. On the traditional loan, you have $84,381 left as your remaining balance. On the all-in-one, you have zero remaining as your balance. However, just so we're comparing apples to apples again, you had 141 months that you were saving $300 a month net. So that would come to $42,300. You also had the $13,500 that was sitting aside in your emergency fund. Now, if you wanted to take this savings and throw it against your principal balance, that would take your principal balance down to $28,581. Now, you can't get that money back out. The $100,000 is still fully available to you on the all-in-one loan. Now, let's say you wanted to continue to pay that $734 a month. It would take you 46 months to pay off the remaining $28,581. So that would be a total of $33,764 that you would be paying over that 46-month period. Over here on the all-in-one, since you're not needing to make a payment anymore, you get to start saving that amount. So you get to save $33,764. So now at the end of that 46-month period of time, you're down to zero left over in your mortgage balance, but you have zero cash available. Whereas on the all-in-one loan, you now have availability of $133,764, $33,764 in cash, and $100,000 in the line amount that is still available for up to 30 years. Can you see why this is better? Hopefully you can. Hopefully this all makes sense to you. Again, check the link at the end of this video that's going to talk about the yield curve and what that's going to do to help reduce your payment and make this work even better for you. Thanks for checking out this video.